Welcome back to another episode of With Stoner. It's the day before Thanksgiving. We are here. We're live for you. It's Tony and Luke. It's just us today. We've had a couple of guests lately, but it's just you and I.
Hey. Dynamic duo.
The dynamic duo. The dynamic duo. That's right.
Yeah, first time we've been just the two of us since F3.
That's it. It's a good time. I'm excited for it.
Yeah, it'll be good.
It'll be a good time. We got a lot to talk about. We got to finish out the year here, right? We're gonna have some more guests coming on some episodes after Thanksgiving, but Thanksgiving's an interesting time.
Yeah.
In the freight markets. Well, I mean, it's an interesting time in general. By the way, are you a turkey fried guy or?
Yes. If I had to choose, that's the way to do it. It just kind of, turkey, if you cook it any other way, well, I shouldn't say any other way, but like if you cook turkey
in smoked.
Smoked was the one I was going to say would be good too. But if you cook it in the oven and you cook it a little too long, that thing, it turns dry really quick. Whereas the fryer or the smoker, you probably aren't going to have that problem. So what about you? What's the preferred
I'm just gonna be honest,
method?
I'm cooking stromboli for Thanksgiving, so.
Mr. Italian over here. Mr. Italian.
Maybe a little bruschetta too. Nobody said you had to have like turkey and mashed potatoes. I'm just saying, like, if I'm gonna eat carbs, it's not really. Like, I'm not gonna choose mashed potatoes. I'm gonna choose like stromboli or something like that actually tastes good.
You could be Anthony Smith and eat salmon and mac and cheese.
That's true. You could, and what an interesting combination between salmon and mac and cheese. But anyways, we're not here to talk about salmon and mac and cheese today. We're here to talk about the freight market. So Thanksgiving is traditionally we usually actually see a bigger bump in demand for Thanksgiving than we do actually right before Christmas, which makes sense, right?
Yeah, I mean when you think about especially historically, when Black Friday was like the holiday, or I don't want to say the holiday, the retail holiday, because that it is. It was that driver of demand. I mean, you've got between food and things like that, but then you've got those holiday shopping season really, like, it used to be the kickoff was Black Friday. Well, now that's kind of like moved forward. So you just don't really see, I mean, you've seen it a little, but I mean, you see bumps in September and October where things are moving. And I mean, if you look at our tender data, especially our volumes, right? I mean, kind of the same trend this year. Things started moving a little earlier. It wasn't peaky. I mean, it wasn't a peak, but there was a little slight bump there back in, mid-October? Or late October?
Yeah.
So, I mean, so it's like the shopping season, almost, that retail season almost gets started earlier, which I think is going to be a trend you see moving forward. I mean, you look around.
Black Friday deals are started.
They've been going on since October 1st.
All month. I mean, so a lot of the peakiness is more so, inventory replenishment, moving stuff around.
Yeah, I mean,
you're ordering it online, or a lot of it.
And then the other factor is they had so much inventory, they weren't moving new things, right? They were just trying to clear. They're trying to clear inventory, which, if you look at their third quarter earnings releases, they did an okay job. I mean, inventory levels are still elevated compared to where they were a year ago, but they're not 30, 40%. They're in like the mid-teens, which is when you start factoring in inflation numbers in that stuff, because they aren't typically adjusted for inflation, it's not near as bad as it was earlier in the year.
Early in the year, they really had to do a lot of discounting to get it out. I think that's why we saw a couple hits to earnings. But there is some interesting news, and I think from an inflationary perspective, or dare I say deflationary perspective, we're getting some good news on the fuel front. We'll talk a little bit about that later in the episode, so stay tuned. We've got a lot of good information here on diesel front, especially what's going on the rack world in the Northeast, especially. So we'll see if that spills over. So stay tuned for that. But yeah, let's go ahead and let's pull up just demand real quick. So we're going to look at our demand chart. We've seen this before. Great snapshot for where the overall market is. So you're getting a tiny little blip there as we roll into Thanksgiving. That's again, we're looking at that dark blue shaded line. That tiny little wick up you see there, that's as of this morning as we head into Thanksgiving. We've seen that every other year. So although we are still quietly suppressed from the pandemic years, but pretty much in line with what 2019 saw at this point.
Yeah, I think what's interesting here, I mean, you look at it is a little bit of an uptick. But really, volumes right now are still kind of lower. I mean, they're lower than where they were at the beginning of the month, which is abnormal. I mean, it's not what you would typically see. I mean, even if you look down at 2019, you see a ramp up into this. We're seeing the ramp up, but it's because we came off and now off of the end of October, and now we're ramping back up to basically where we were at the same time. It's not like, and guess what? When we get the data for Thursday, so on Friday, when we see it, it's effectively a 0 day. It's going to drop just like the rest of them did. So the real telling one's going to be when we wake up tomorrow, and if you check OTVI on Thanksgiving morning, what does it look like on that Thursday? So today's data, is there a significant bump up like we've seen, or is it going to be kind of just another little notch higher that's not really overall, it's not a peak?
Yeah, and the rest of December will be interesting too, because we traditionally see December fall a bit. The question will be, does it fall faster, right? And the same thing, like when things are going down, nothing falls in a straight line, right, except for FTX. But otherwise, pretty much everything falls, stair-stepping there. Sorry if you were in FTX. Terrible situation.
Well, and I think one of the important, like in December, it's interesting because like the time-sensitive nature of some of this freight, it either ramps up or it's basically gone.
Right.
So I mean, like,
they either have to have it by now if they're going to sell it,
or they're in a rush to get it, and
and
that's where you can see volumes in December on contracted volumes kind of decline, but you may see spot rates still react because one, you're going to have some capacity come offline. I mean, that's just natural with holidays, but you may see people start pushing loads into the spot market because of that time-sensitive nature. Is it going to be as impactful as it was in 2020 and 2021? Probably not, just given how soft the freight market has become. But it's definitely something you could see in December.
Yeah, where a lot of my eyes go now here is like we've seen the demand, and I think really at this point we're just kind of curious, are we going to dip below 2019 levels? And we'll figure that out probably here in the next couple of weeks or not, and even Q1. But contract rates are doing something pretty interesting right now. Contract rates, we saw contract rates peak in like between March and April for the most part, but they started to come down, then they stayed flat for a little while, and it almost feels like we're starting round 2 of the dip of contract rates.
Yeah, I mean, it's kind of how it works when you think about how contracts are kind of implemented, right?
Yeah.
If you ran a bid in August or September, you're starting to see the impacts of that show up now, right? Where shippers are adjusting the rates lower because obviously you look at rejection rates sub 5%. There's available capacity to meet any amount of demand. That's why you haven't seen rejection rates move a whole lot around Thanksgiving, because like there is capacity to meet any uptick we've seen in demand. But if you look at contract rates in the past, few years, it wasn't just this steady increase, right? Like this long drawn out line, this uptick. It was a stair step up, right? Because, you've got quarterly bids, right? Every 6 weeks there's a bid or something like that. It's not like a constant day-to-day, week-to-week change. It is more of they're shorter bid cycles in nature than what that annual bid cycle was, but they're still on this cadence that causes this stair step. I think what you're going to see is when you start comparing contract rates to spot rates, the NTIL, specifically the National Truckload Index excluding fuel, there's still a lot of runway for contract rates to fall.
Yes.
And I think that's going to be the key is it's not what we see in the fourth quarter, because we're 5 weeks away from the end of the year. It's going to be, what do we see in Q1 that really tells us about how the freight market and how these shippers are reacting to the changing market conditions, and how are carriers reacting, right? Because
we've seen, looking a bit more anecdotally here, I pulled up on my phone a couple of the articles that we've seen come out this week. Like a lot of LTL carriers, including XBO, are having, due to falling volumes, are dialing back on drivers. We saw, I believe it was it NUFI announced mass layoffs yesterday, in fact. As due to unforeseen business circumstances.
Yeah, I mean,
so we're starting to see a lot of that happen with a lot of these asset carriers.
You look at what UFI really kind of was. I mean, what was it? United Furniture.
United Furniture Industries.
Doing business, and they do business like as lane brands. So, I mean, it's furniture. Guess what? That's discretionary spending that the consumer is pulling back on because they don't need to. Well,
how many couches do you need?
Well, that, and did you go and buy one during the pandemic?
Right.
Well, do I need a new couch, or do I want the TV that's on sale? Do I need the couch?
By the way, TVs are a great deal right now.
Yeah.
If you need one.
Do I want to make sure I have enough to buy the necessities? I mean, I was talking about it earlier today. You look at food prices. I mean, they're up almost double digits. They are up double digits or at home, at grocery stores. I mean, they're up like 12.4% year over year, the CPI is.
Yeah.
At restaurants, or away from home as the CPI calls it, I mean, they're up like just at about 8.5%. So, I mean, there's still, I mean, you're talking prices that are elevated. You look at gas spending, or gas prices, right? I think CPI there, 17.5% higher. So, I mean, you look at the retail sales number from October, it was up 1.3% month over month, 4% increase in gas spending. So it's like that unforeseen business circumstances. I mean, when you start to understand this is changing consumer behavior, and if you're just denying that the consumers are changing their behavior, this is the stuff that happens. And I think that's the issue, is like it's hard to, I mean, once you see Walmart's and the Targets talk about, they're seeing consumer behavior kind of change in terms of who's shopping there or what they're buying, everybody else is feeling it too.
Mm-hmm. Yeah. No, you're spot on, and that's really where we're seeing a lot of. I think we're continuing to see a lot of downward pressure on a lot of these rates. I mean, we'll throw up, just for folks that haven't seen it yet. Let's throw up the contract rates here that we were talking about earlier. These are. It happened. I guess it was about 10 days ago now. Contract rates officially went negative year over year.
Yeah.
This is line haul that we're looking at right here. So we've pulled out fuel. So we're sitting at $2.63 a mile right now. And again, we would expect that to go lower now. And that's the thing, is like, you're lower year over year. And it's not like we're comparing this to like the peak of where it was in this year. I mean, you're talking last year, while those rates were still a little bit lower. So I mean, we're falling, and like you said, there's probably another 10 to 15% to fall based on where spot rates are.
Oh.
And if you look at where spot rates are headed, let's flip real quickly to this. We'll pull up the spot rates with the forecast. That right there, right? Contract rates have been following spot rates. They've just been about 6 months behind. I mean, look at this right here, right? You've got blue line here is the year-to-date actuals, right? And then that yellow line there is the forecasts. That looks really healthy, doesn't it? Yeah.
You've seen some positive momentum in spot rates over the past couple of days, right?
And it's forecasting another little bump for probably the next
and
like
directionally, I mean, the forecast is great. Again, we talked about it last week. Like it directionally, it's been spot on. I mean, you see it vary a little, right, in terms of how fast it falls or whatnot. But directionally, it's spot on. And I think the concern is you're heading into December, which obviously November really is the peak for truckload.
Sure.
So you're going to be past it. But I mean, if you look at that forecast, right, the peak was April or March. I mean, it's not November. How many times do you think spot rates peak in March for the year? It's very rare. I mean, the comps coming up in Q1 are just going to be almost impossible because it's, I mean, how crazy the market was this time last year. I mean, you think about in January, there were 109 vessels off the coast of Southern California. I think I saw yesterday there were zero. So, I mean, that's part of the reason demand is just done exactly what we thought it was going to do once we started to see overseas, hey, there's less volume coming. And then the shipments, and this is a topic I've been talking about a lot recently, was the average shipment size, so TEU per shipment has really come down. So shipment levels, they were a little slower kind of to react, but the TEUs per that shipment fell. And it's still kind of in that way. Whereas prior really to the pandemic, you saw them kind of move in lockstep. And then during the pandemic, you saw TEUs, more TEUs per shipment. So now you're seeing it kind of reverse that. And eventually it'll probably get back into that like lockstep movement. But I mean, you look at this forecast and it is a bleak outlook in a time where hopefully rates would have stayed a little higher.
Right. Yeah. So we'll see if rates fall all the way down to that level there where the forecast is going. I mean, again, directionally it's right nearly every time. Yeah. We'll see if it gets the actual percent move there, but directionally it's been pretty tight. It'll definitely be interesting to see where it all lands. The thing with imports too is I think approximately CEO of Flexport was tweeting out the other day that about 35 to 40% of containerized imports move via rail. So, I mean, you have almost 60 to 65% of those imports are flowing to truckload. That's a massive amount, right? And the fact that those have all come down, right, that's directly impacting a lot of those truckload shipments.
Yeah, and it's not, like you said, 30, 40% flowing to rail. Go look at rail volumes, what they've started to do. I mean, it's kind of telling when every indicator is moving downward. And it's not like, hey, intermodal, the rails are taking share from truckload because, we don't need it. Well, their volume's declining too. So it's hitting all sides of really the market. And you mentioned it, LTL, right? Like furloughing drivers. Well, guess what? Like you wouldn't do that when demand's high.
Yeah, exactly.
Like it's kind
especially
of like,
around this time of year.
Yeah, exactly. So,
but we've got some good news though. This is what I like about Sonar. Sonar allows you to see the whole picture, right? And we've talked a lot. So yes, demand is down and rates are down. And one thing that a lot of carriers have stressed is like that's been a real pain in their side is that rates are going down while fuel is going up, and that's been such a challenge to them. It's absolutely destroyed their margins, as you may expect. I think fuel is the second biggest cost for carriers, right? Labor being number one. Yeah. But we've seen so one data set we track in Sonar. It's called it's ULSDR, which stands for Ultra Low Sulfur Diesel Rack. Basically, it's diesel rack prices. Yep. Rack being the wholesale price, which tends to move before retail prices.
Yeah, because I mean, if you think retail locations or retailers are buying their fuel at that price, then they mark it up, whatever that spread is, and that's the difference. And they're having to pay taxes and things out of that margin. I mean, you listen to any retailer, they're not making money on fuel.
Yeah, it's not a lot.
It's a lot smaller than what you think it is. They're making money if you go in the store. Yes. Like that is their goal, is to get you in the store because that's where they're making their money. So it's not the fuel aspect. What's interesting now, that said, some of these larger enterprise carriers that have these fuel surcharges, right? They can be baked off the rack price, plus or minus a few cents here and there, depending on their contract that they work out, right? And then they can turn around and charge their customer, so the shipper, that retail price. Yeah. So they could make some. It's a good thing when it spreads really wide for those carriers, but the ones that are having to buy fuel at the retail prices, they want to see rack prices move lower because eventually it's going to flow over. Right. Because station owners kind of get comfortable. They're like, okay, our cost has gone down. We can drop the cost. They're slower to do it, but they kind of have that comfortability at a certain level to start moving prices lower.
And we've seen some really big moves over the last 30 days. Let's go ahead and throw this up for folks to see. So just for reference, this chart is our tree map. The top left means that's the most expensive rack or wholesale fuel price. The bottom right box is going to be the cheapest rack or wholesale price. So again, this is for diesel. So Erie, PA is bottom right. You're sitting at about $3.66 a gallon. Again, that's the rack price, the wholesale price. And then Bristol, New Hampshire up there in the top left, sitting at about $4.50 dollars. So, but the percent changes that you see on top, that's over the last 30 days. Yeah. A big one I want to call out is Allentown, Pennsylvania. Big warehouse market, Allentown. down 21% over the last 30 days. That's big time.
Yeah, I mean, look at Harrisburg right next
Harrisburg,
to it, right?
right next to it.
21.8, also a big warehousing. So, I mean,
Philadelphia almost down 20%. I mean, Pennsylvania is getting a pretty big break right now.
So, if you looked in the Daily Watch today, I saw you talk about this on LinkedIn yesterday. Yeah. I took it, because you can put this in a map, right, and look at it. And I looked at it on a weekly level. Okay. And you're seeing a lot of this decline in the past week. So, like, you can kind of look at it multiple different ways. But, I mean, ultimately, in the Northeast, this is a welcome sight, because that's where we talked when the diesel shortage was brought up initially, that, hey, the Northeast, maybe we're running out of diesel. Prices went up there. Yeah. Well, this is just kind of a welcome sight of returning back to, hey, maybe things aren't so dire in the Northeast. Yes. So it's definitely a welcome sight. I mean, it's obviously the prices in the Northeast are naturally higher. I mean, they just are. If you went to our retail price and map and put it up, the center of the country is cheaper. West Coast and the Northeast are the two most expensive regions. Yep. It's not a surprise, or shouldn't be a surprise. But you see this, it's kind of a welcome sight. It's
a welcome sight. I paid $2.99 for gas last week, I think, here in Chattanooga, Tennessee. Now, that's obviously not diesel.
Gotcha. But I mean,
we're heading in the right direction.
Yeah, I mean, I think I got a discount, but I think I paid $2.79.
Well, okay, hold on now. Hold on.
Hey, shop at Food City and go buy gas.
This guy over here, he's got under the table deals.
So it's all right. But I mean, you think
you would suggest that everybody should short oil stocks based off of this? Is that what you're saying, Tony?
I'm not saying that.
Oh, you're not saying that.
That's financial advice. I'm not giving financial advice.
We don't do financial advice.
No.
Oh, okay. Got it. No. So that's not what this is. Okay, my bad. But no, it is a good sign, right? Yeah. Shippers, as this continues to trickle into the DOE, which I know lags a bit, but which actually could be good if you're moving contract freight. You get a little bit higher fuel surcharge, but then you're paying a little bit less at the pump. So there might be a little bit of grace there. Yeah. Shippers will eventually start paying less on fuel. That should help ease their budgets a little bit. And then even if rates do continue to decline, especially if you're moving spot freight from a carrier's perspective, you'll hopefully be paying a little bit less at the pump. So you might get a little bit of cushion.
Yeah, especially when you think about spot freight as it's typically an all-in rate, right? Yes. It's not a line haul plus fuel. And so when you get a rate, like that's the rate. You've got to operate within that. That's why we've talked about it for a while when we've seen the market shift, talking about owner-operators. Know your operating expenses. Know what it costs to drive your truck on a per-mile basis, because then you know what it's going to cost in the long run, right? Mm-hmm. You're going to have variable costs like fuel because it changes based on where you're at, right? Yeah. It's a consistent cost, but it changes based on where you're at. So it is that variable aspect. But if you can understand, hey, find that average miles per gallon that you get, whether it's 6.5, whether it's 8, whether it's 10, figure out what's it cost for the national average price. And then you can back in, what's my truck payment on a per mile basis? And how many miles can I run? And if you can back into that, you can understand, hey, I can run this lane at this rate and break even or make some money. And then you can understand kind of where your losses may come from, right? Understanding how do I keep that operating ratio, right? So that I bring $1 in, and I want to only spend 90 cents, right, to operate. Figuring that out is so vital in a market like this that's changing, but then we're also going into the bottom at some point. And how long can we stay at the bottom? And if you know that stuff, yes, it might be tough, especially compared to the previous definitely compared to the previous 2 years. But you can kind of weather the storm if you understand some of those dynamics.
No, 100%. And the good news with a lot of that is there's a solution now, if I may be so bold.
Yep.
It's called Stack Up. So Stack Up is actually a new program we started where you are able, as a carrier, you're able to benchmark your financial metrics with other carriers. Mm-hmm. You know, hey, this is my average fuel expense per mile. This is my labor expense per mile. My, empty miles percentage and all that stuff. Here's the best part. It is free.
Yep. Exactly.
Free for the first year.
Yeah, I don't know why anybody wouldn't do it.
Great opportunity to see how the finance, especially now, right? Now is the time to really tighten things up. Like when things are like this, right? You really have to run a tight ship.
Yeah, I mean, you got to run. I don't want to say lean, but you got to tighten the belt. And
lean and
mean. You don't want expenses that are just out of control or things like that. You just need to understand what those are.
It's kind of like you hear the magic number, like growing up, like it's like, oh, you got to have $1 million saved away at retirement in order to retire to live off the 4% rule and all. It's like, well, you know, probably gonna have to be a little bit more than that by the time you get there. So continuing to make that number a little bit bigger. Yep. But anyways, folks, we're out of time. Luke and Tony here. This has been a great Sonar episode. We'll see you next week live. We will be back Wednesday at 3:30 p.m. Eastern time. Everybody have a fantastic Thanksgiving. And remember to stay safe. Cheers.